The average person doesn't know what risk in finance is because there's lots of different types of risks. I'll make you smarter than the average person in less than 3 minutes. Risk in finance refers to the possibility that an investment or financial decision will result in a loss or lower than expected financial return. There are several types of risk in finance. There's market risk, credit risk, inflation risk, and liquidity risk, among others. Here's an example. Let's say you invest in a stock and it decreases in value due to a sudden market downturn. This is an example of market risk, which is the risk associated with changes in the value of investments due to market conditions. Another example of risk is credit risk, which is the risk that a borrower might default on a loan or bond. For instance, if you invest in a company's bond and the company goes bankrupt, you may lose some or all of your investment. Liquidity risk is the risk that an asset can't be easily sold or converted into cash without incurring a loss of any value. This risk is particularly relevant for investors who may need to access their funds quickly or who are invested in assets that may not have an active market or that are difficult to sell. Then we've got inflation risk. Inflation risk refers to the risk that the purchasing power of money will decrease over time due to inflation. For those of you that don't know, inflation is the rate at which the general level of prices of goods and services is rising, and it erodes the value of cash over time. One of the most famous commercial examples of risk is the collapse of Lehman Brothers in 2008. The investment bank's risky investments in subprime mortgages ultimately led to its downfall and had a major impact on the global financial system. Risk is an inherent part of investing, and investors must be willing to take on a certain amount of risk in order to potentially earn higher returns. However, it's important to manage and mitigate risk to ensure that it doesn't have a negative impact on your overall financial situation. Not all risk is bad. Some level of risk is necessary in order to earn higher returns, and taking on more risk can sometimes lead to greater rewards. Investors can manage their risk by diversifying their portfolios. By spreading their investments across different asset classes and industries, investors can reduce their exposure to any one investment or sector. Risk is an important concept in personal finance as well. For example, taking on too much debt or not having adequate insurance coverage can lead to financial risk and potential losses. Financial professionals such as financial advisors, risk managers, and underwriters help individuals and businesses manage risk by analyzing potential risks and implementing strategies to mitigate them. Overall, risk is an important concept in finance and investing, and understanding the different types of risk and how to manage them can help investors make more informed decisions and achieve their financial goals. Does that make sense?